Tonight's program is part of the Farm Bureau's continued efforts to help members gain resources and information to best prepare them for their retirement years. By bringing together resources from our best partners nationwide, the next several minutes are your chance to gain insight and ask questions with experts to ensure you are able to have the retirement you want. I participated in this program a couple weeks ago with Nationwide, and although I am far, far, far from retirement, I gained some great insights to start putting my mind in the right direction to planning my own future of my farm. So I hope you enjoy this presentation as well. I'd like to turn it over to Tim Hicks now. He will be our guide through this evening's program.
Thank you very much, Ivory, and I'm really happy that folks are going to be able to join us and get kind of a quick glimpse into some of the opportunities and ways to better prepare for your retirement future. So tonight's program, we have two presenters. One is Brad Wingler. He's a regional vice president with Nationwide Retirement Plan Services. And he's going to be going through some content that really just kind of sets the stage for different life choices and kind of where and what the opportunities are to frame out the retirement plan that's going to fit you and your family's need. And then we'll have John Wilbur with Wilbur Price Insurance Group, going to be talking about a couple different known challenges in retirement and focus on a couple key features that you might be able to use to your advantage as you prepare for your financial future.
My name is Brad Wingler. I'm the regional vice president for Nationwide. Been in the financial services industry for about 27 years. So unlike Ivory, I am more towards that, getting more towards that latter end of the retirement. As opposed to the early side. And I've been with Nationwide for about 16 years now. So here's our agenda for today. I'm not going to spend a lot of time going over the agenda, and to be frank with you, I'm going to kind of skip through a number of the early slides. Part of it is things that John's going to cover in his presentation. I'll hit the high points of it, but really we'll focus on the retirement plan portions of it towards the end. Let's talk a little bit about Nationwide's commitment to the ag community. And we're really going to focus on the retirement plan side of it, as I mentioned. Obviously, Nationwide has a number of different products, both on the insurance side of the house and the financial services side of the house. They're important in the agricultural community. We're going to focus strictly on the retirement plan side of it for today. Some of you may know this, but let's just talk a little bit about Nationwide's history. Many of you may know that Nationwide was kind of born out of the Ohio Farm Bureau. Back in 1926, we were called Farm Bureau Mutual and started out with a $10,000 loan of borrowed capital from the Farm Bureau. By 1955, we changed our name to Nationwide to reflect our more national footprint. And then in 1982, we acquired Farmland Insurance, which is now known as Nationwide Agribusiness. In 2011, we launched Land is Your Legacy, which I'm sure John will talk a little bit about. And then today, Nationwide is a Fortune 100 company. I believe currently we are number 69 on the Fortune 100 list, and America's #1 farm insurer. So we have grown quite a bit over the years. One of the things that I'm really proud of at Nationwide is Nationwide has remained committed to the to the ag community, but also Nationwide supports the communities that we live and work in. If you go back to 2000, just over the past 20 years, the Nationwide Foundation has contributed almost $500 million to a number of nonprofit organizations. And I think one of the great things is if you look at the list of organizations on the screen, a lot of them are either directly agricultural related or indirectly agricultural related. And I think it does a good job of saying that Nationwide understands our roots. In fact, if you were to look at the board of directors at Nationwide, more than half of them are actually farmers. So we do get where we came from. You can go to the next slide, Tim. Actually, 2 slides. So let's talk about some statistics about farmers. And these will become a little bit more relevant later on as we talk about the different types of plans. But there's over 77,000 farms across the state of Ohio, and about 91% of those farms are owned by families. That's important because usually family-run businesses tend to have retirement plans that are IRA-based plans. Not always, but many times. And that's not the case in most other industries. And so what that means is, when I talk about the different types of plans, IRA-based plans may work for many, many farms. Only 29% of family farms have a transition plan in place, which means you probably ought to pay attention to when John talks, particularly the land is your legacy part of it. And then nearly 24% of Ohio farm producers are under the age of 44. You can go to the next slide, Tim. So let's start talking about retirement. One more slide. So what does retirement mean to you? Retirement means something different to everybody. And really, when you start to think about retirement and start to think about how much money you have set aside, one of the things you really have to consider is, what is it that you want your retirement to look like? For some people, retirement means doing the same thing you do today. Maybe you do less of it. Maybe you don't. Some people work until the day they die. Some people decide to pick up hobbies, whether it be gardening, golf, camping. For me, it'll be fishing. For me, retirement, a successful retirement is a bass boat in a pond somewhere. Pond or lake, whatever, anywhere the bass are. So it means something different for everybody. And the point is, what you should think about is the amount of money that you need to have set aside for retirement should fit what those goals and objectives are for you. Whatever your retirement dreams are, that's what you should try to save for. So one of the things that you may want to also consider is your objectives are going to change over time. I think we made this slide for Ivory. In fact, that might be little Ivory when she was first born in the middle there. I'm kidding, sorry. So early career considerations. Early in your career, your objectives when it comes to your financial situation could mean a number of different things. You're probably focused on things like maybe buying a business, buying a farm, maybe saving for your first home, starting a family, things like that. Retirement is probably not the biggest focus of when it comes to your goals in life. We always try to keep people informed of the fact that while that may not be the case, the thing that you want to consider is the earlier you start saving, the better. And we really try to drive that home when we talk to people. Even if it's only a little bit of money, the monies that you were able to save early in your career, those are going to have the longest time to compound, which means it can have a huge impact, positive impact on your retirement situation. As you get into mid-career, things start to become a lot more complex, and they become a lot more complex for many reasons. Your business may have grown by this point. If you've had children, your children are getting older by this point, probably. I'm a father of 4. One of the things I always say is bigger kids, bigger problems and more expensive problems. As kids get older, you start to think about things like cars, driving, college, the expensive college, things like that. So the decisions the things that you need to consider become a lot bigger considerations as you get into that mid-career, and a lot more expensive considerations. The good news is you're probably more closer to your peak earnings years by then, which means you probably have more money to set aside for saving for retirement by the time you're in those mid-year, that midpoint in your career. As you near retirement, things really become much more urgent when it comes to retirement savings. Planning for retirement is a retirement of dignity is really, really important. At this point, you're trying to make up for any shortfalls that you may have in your retirement savings. Thinking about things like Social Security, which you didn't think about when you were younger, life insurance, long-term care, all different kinds of things that become a lot more critical to think about. These are the times when I always say it is not just more important, but critical to start thinking about those things as you get closer to retirement. And it's critical that you probably start to work with a financial advisor as you start approaching those retirement years. So let's take a look at a little bit more at your retirement plan options. And this is where we're going to spend the majority of our time. You really have 4 different types of options. You have 3 different types of IRA-based options. So you have individual retirement accounts or IRAs, simple IRAs, and SEP IRAs. An individual retirement account can be set up by anybody. The middle 2, simple IRA and SEP IRA, those have to be sponsored by the business. So the business has to set that plan up. And then we'll talk about defined contribution plans, 401k and 403b plans. Let's start out with the easy part. We'll talk about traditional IRAs and Roth IRAs. Many of you may have traditional IRA or Roth IRA accounts. They're really easy to set up. Any individual can set up a traditional IRA or a Roth IRA, and you can do it at just about any financial institution, whether it's a bank, a brokerage firm, an insurance company. Just about any financial institution can set up an IRA or a Roth IRA for you. That's the upside to it. Another upside to it, you can put in up to $6,000 per year, and there are tax benefits to it. Here's the difference between a traditional IRA and a Roth IRA. I often get the question, which one is better? The short answer is, I don't know. It depends upon your individual facts and circumstances, and you really should talk to a financial professional or your tax advisor to figure out which one's better for you, because one isn't better or worse than the other. They're just different. So with a traditional IRA, think of it this way. You get the tax break on the front end, whereas with a Roth IRA, you get the tax break on the back end. So with a traditional IRA, we'll just use an example of somebody who makes $50,000. You make $50,000 and you contribute $6,000 to your IRA, you get a tax deduction of $6,000, which means when you file your taxes at the end of the year, you're only going to pay taxes on $44,000. And that's what the IRS considers you to have earned for the year, is $44,000. They give you a tax break or a tax deduction for that $6,000 you contributed. By the way, if you're over 50, you can contribute $7,000. I just turned 50 this year, so if I did a traditional IRA, I could contribute $7,000 to my IRA. The money in your IRA grows tax deferred, so you get that tax break up front, it'll grow tax deferred, but then when you pull the money out of the IRA, you start to pay taxes on it. So you pay taxes on both the principal and on the gains in your IRA. Now, because of that, you probably spread those distributions out over a period of years and use that as a portion of your retirement income to live off of. A Roth IRA is kind of the opposite. You don't get that tax deduction up front. So if you made $50,000, you contribute $6,000 to a Roth IRA, it grows tax-free. And when you take the distribution, you pay no taxes on that distribution, whether it's all at once or it's over a period of years. So if you think tax rates are going to rise in the future, a Roth IRA might be good for you. But again, not a right or a wrong, they're just different. If you're not sure which one, I would talk to your financial advisor or your tax professional to figure out which one's a better fit for you. Advantage, again, really easy to set up. Next slide, Tim. So now we're getting into employer-sponsored plans. So in order to have one of these plans, your employer has to sponsor it. And they're simple IRAs and SEP IRAs. We're going to go backwards and start on the right-hand side, and we're going to talk about SEP IRAs first because, frankly, they're easier. SEP IRAs they're individual accounts, but they're completely employer contributed. In other words, when the employee cannot put their own money in the account, the employer has to contribute to the account, and they put a percentage of each employee's compensation into the account each year. So if you're an employer and you have, say, 10 employees, and you decide to set up a SEP IRA, you can contribute, if you contribute, say, 20% of your compensation to the SEP IRA, you have to put the same percentage in for your employees. For that reason, I always say a SEP IRA is great if it's a very closely held business, like a family farm, where the only employees are family members. If you have employees who are not family members, I would tell you that a SEP IRA is probably not a great idea for you. And the reason is because each of the employees, you have to make a contribution for each of the eligible employees, and it's the same percentage that you get for yourself. It's a great deal for the employees. It's not a very good deal for you. You take all the risk of owning the business, the farm. You're the one signing the mortgage. You're the one who's got something at risk, but they get just as much as reward as you do. Not a great deal. I always use a perfect example of somebody who's a good example of a SEP IRA candidate is my older brother. So I have two brothers, one older, one younger. My older brother is a retired Navy SEAL, which means he's a really tough guy. It also means he doesn't play well with others. So now that he's retired, he's a self-employed carpenter. He does not have any employees. He will not ever have any employees because, again, he doesn't play well with others. So in my brother's case, a SEP IRA is perfect. He puts 25% of his compensation into the SEP IRA every year. He's got good retirement from the Navy. His wife still works. Doesn't really need all the money he earns. He puts 25% of his compensation into his SEP IRA. He doesn't have to do that for any employees because he doesn't have them. So that's a SEP. On the left-hand side, we've got simple IRAs. Simple IRAs are going to kind of look and act a little bit like a 401k plan. So if you're familiar with how a 401k plan, it's going to look similar to that in a simple, the employee can defer their own money into it. In fact, the employee can put up to $13,500 of their own pay into the plan. And you may have some employees who choose to contribute and some employees who don't choose to contribute. And then if you're over 50, you can put an additional $3,000 catch-up contribution into the plan for a total of $16,500. They're all traditional contributions, so you can't make Roth contributions into a simple IRA. So the money will grow tax deferred. You get a tax deduction when you put the money in. When you pull it out, you do pay taxes on it at that point. Here's a downside to a simple IRA. It's not very flexible. When you set up a simple IRA, you have two options as the employer for how you fund it. You can either do a matching contribution, which means if the employee puts in 3%, you put in 3%. The employee puts in 0, you put in 0. If the employee puts in 10%, you still only have to put in 3%. That's one way to do the simple is by doing the matching contribution. The other way is you make a contribution. It's called a non-elective contribution, which means, you contribute 2% for every employee who's eligible for the plan, whether they contribute or not. It's not a right or a wrong way to do it. Some employers prefer to give a little bit to everybody, whether they contribute or not. Some employers have just decide, look, I want the employee to have some skin in the game, so if they don't put their money in, I don't want to have to match it. Downside to a simple, two things. One, it's not very flexible. You either do the 3% or the 2%, and that's it. Two, contributions, while they're a lot better than it is with an IRA, they're not incredibly high. So it's not the highest amount that you can contribute to a plan. But again, they are very easy to set up and very easy to maintain. So not a bad option for many many situations. I always say if the business owner is going to contribute up to 13,000, less than 13,500, a simple IRA might be a good opportunity for that. Next slide, Tim. One too far, too far. We're going to talk about 401k plans. There you go. 401k plans are what are called qualified plans. And I want to make sure that we sort of make sure that we're on the same page when you look at the screen, because this slide is a little bit complex, and I would have designed it a little bit differently. But on the left-hand side, it says 401k and 403b. Keep in mind, a 401k and a 403b are essentially the same type of same plan. They're not exactly the same plan. Think of it this way: a 401k is a plan that would be set up for a for-profit business, and a 403b is a plan that would be set up for a nonprofit. Almost all of the provisions of both plans are identical. There are some very, very minor differences between 401k and 403b plans that really aren't even relevant to the discussion today, but think of them as being the same type of plan. The other thing that is a little bit weird in the way this slide was put together is think of the 401k and the profit sharing plan as really being one plan, not two separate plans, because the way it's shown here, it looks like it's two separate plans. The contribution sources, in other words, the money that the employee defers versus the money that the employer puts into the plan, they're tracked differently, but it's all held in one account. In fact, 401k is actually just the provision of the IRS code that allows an employee to put money into their employer's profit sharing plan. That's all the 401k is. So in other words, a 401k is actually a profit sharing plan. So explain how it works to you in terms of the basics. With a 401k, you can have employer contributions and employee contributions. The contribution amounts are much higher in a 401k plan. Each employee can defer up to $19,500. And for people like me who had 50 this year, you can defer up to an additional $6,500 in catch-up contributions for a total of $26,000 in a 401k plan. In addition, you can also make profit sharing contributions and or matching contributions as the employer. So there's a lot of different ways that the employer can set the plan up. If they want to make a matching contribution for every dollar that the employee puts in, they might say, well, I'll match 50 cents on the dollar for, say, the first 3%. It's as flexible as you want it to be. You can really make it whatever you want it to be. The only thing that you have to keep in mind is two things. One is you can't discriminate. In other words, what you do for one group of employees, you have to do for all employees. And the other thing is you can't exceed $57,000 total benefit in that plan for any employee in the plan, including the owner. We can really design it. We have a lot of flexibility to design it in a lot of different ways to accomplish a lot of different things, depending upon your individual situation. So the positives, it's very flexible, number one. Number two, higher contribution limits. On the negative side, there will also the other benefits, you can allow loans in a 401k plan if you want to. That's your decision as the business owner. So if you want the employees to be able to borrow money from their plan, including you as the owner, you can do that. You can also have what's called a vesting schedule. So any employer contributions, whether they be profit sharing contributions or matching contributions, you can say, hey, the employee has to be here for X period of time before they get to leave with all that money if they leave employment. There are limits to how long you can do that. I actually had an employer once who said, I want it, if they leave before 20 years, I don't want them to be able to take the money with them. You can't do that. The maximum period of time is 6 years. But it's a lot more flexible from that standpoint. Downside to a 401k plan, you do have an IRS filing at the end of the year. You have to have a plan document, and you have to file what's called a Form 5500 at the end of the year. Keep in mind, you don't necessarily have to be the one to do that. Typically, when we set up a plan with a client, we set them up with what's called a third-party administrator who takes care of all of those administrative things for you. You don't have to worry about doing that. You've got a business to run. Let's look a little bit at, one of the things that we hear from, well, we hear a lot of different things when it comes to the attitudes of retirement plans. And Tim actually, I don't know if it was Tim directly, but the Farm Bureau actually did a survey related to retirement plan attitudes. And I won't read all of these to you, but as we're finishing up here, too much hassle and not enough time to manage. That's fair. I want to worry about running my own business. I'd agree with that. I don't want to spend a lot of time. I wouldn't want to spend a lot of time running a plan. And it's too expensive and not enough employees to justify the high startup costs. That's probably not true. That can be true depending upon the plan that you're trying to set up. One of the things I like to point out is these objections, while they're very valid, they're not unique to the agricultural community. They're really the same objections we hear regardless of the type of company that's setting up the plan. Our job is to make it as easy as possible on you when you have a plan, and also to point out the advantages of setting up a plan. So next slide, Tim. There's a lot of different advantages to you as an employer to setting up a plan. There's a number of financial advantages and tax advantages. One, all the employer contributions are tax deductible. So if you're making matching contributions or profit sharing contributions, those are tax deductible to you as the employer. Any plan expenses that you may pay as the employer are tax deductible as well. And the government actually wants you to set up a retirement plan for your employees. In fact, at the end of the year, this past year, the government extended the number of tax credits that you can get as an employer for setting up a retirement plan. So they really want you to set up a plan for both yourselves and your employees. And the reason is because they don't want you to retire with just your Social Security, because that means the government's going to have to help you out in retirement. Other issues or things to keep in mind: if you have employees who are not family members, or even if they are family members, having a retirement plan is going to help both attract and retain them as employees. It will hopefully reduce your turnover because they'll view it as a benefit to them as an employee. And whether it's for you or whether it's for your employees, you can save a lot more than they can for retirement. So next slide, Tim. How do we help you? So this is actually a comment. Some of you may know Mike Boyert. Mike is a member of the board of the Ohio Farm Bureau. I'll read his comment that he wrote. When we were looking for help in our retirement plan, Nationwide came right to the top because of the values they bring to the table. Their heritage is strong, and their thought process, quality of product, and relationships with people mirrors Boyert's philosophy in the business world. Mike Boyert, Boyert Greenhouse and Farms in Medina, Ohio. I didn't put this presentation together, but I am proud to say that I actually did help Mike and Patty Boyert set up their plan for their business. And the way it started was just knowing their needs. We literally sat down at their kitchen table and talked a little bit about what is it that they want from their retirement plan. Where are they trying to get to? And we talked about the existing plan that they had, because they actually had a simple IRA at the time. And one of the things that we were able to quickly figure out is, in order to meet their retirement plan objectives, that simple IRA wasn't going to accomplish it. We needed to set up a 401k plan. So we were able to help change what they were doing and put them in a better situation so that Mike and Patty and their employees would have a better future. Throughout the process, it's my job to be their advocate, help get the people in place to help them set up a plan that works for them as an employer and for their employees, and then also make it as simple as possible for them. We did enrollment meetings for all of their employees. In this case, they were in person. Keep in mind, it's a little bit difficult to do in-person meetings right now. Excuse me. So currently we're doing a lot of those enrollment and education meetings virtually, but hopefully we'll be back out there doing them in person in the coming months. So next slide, Tim. Just wrapping up here. So one of the things to keep in mind is, and this really shined through at the beginning of the presentation when Tim did polling questions. I think 2/3, if I'm not mistaken, of you on the phone are going to have some sort of your retirement income come from your farm or your business. And that's unique, and it's different than many other businesses. I think about myself. My retirement is going to be made up of whatever I get in Social Security, which I don't know how much that's going to be. What I do know is it's not as much as they tell me in that estimate that the government sends me every month or every year. Actually, they don't send it to you anymore. You get it online, but it's not as much as they're telling me it's going to be, but it's probably not zero either. So it's somewhere in between there. And then whatever I save for myself through my IRA and my 401k plan. You're a little bit different because you have a farm that you either can draw income from or can sell or pass along to other family members. So you have different unique situations. So if you haven't talked to John or somebody else about Land is Your Legacy, you might want to think about that. So with that, I am going to turn it over to John, let him talk about a number of different topics, including life insurance, long-term care, healthcare, Social Security, a whole bunch of other topics. So with that, I'll turn it over to John.
Brad, I did have a question. Does a spouse have a traditional retirement plan? So many of the farming families have a few different revenue streams coming into the household. So
Sure.
Maybe they both work off farm and then they both work on the farm, or one works off farm and one works on the farm. And as they kind of work towards that retirement plan, what do you say to someone that has that traditional, that 401k and then a farm, and then how does that farming family kind of take a holistic approach to whether it's traditional IRA, Roth IRA, setting up something that's confined within the farming business, maybe via a SEP if they're the only employee. How would you talk someone through something like that?
One of the things I would always consider is anytime your company, if you work for a company outside of the farm, and that company has some sort of matching contribution for their 401k plan, the first thing I would always advise is take advantage of the matching contribution first. So let's say you work for a company and they match dollar for dollar on the first 3%, or 50 cents on the dollar for the first 6%. Put in at least that much, because that's free money. So it's free money if you're the employee, not if you're the employer, because you're the one paying it. Consider that first. Would be to at least contribute to the level that your company matches. And then after that, it's really a complex question. It's really sort of facts and circumstances. It really depends upon what the rest of your situation is as to whether you should continue to contribute to your company's 401k plan, whether you should be doing life insurance, maybe generating cash value in a life insurance policy. There's a lot of different ways to accomplish it, and it really depends upon your individual situations. I have a holistic approach to it. For those of you who have questions about whether or not you should set up a plan for your farm, or what's the right type of plan to set up, feel free to reach out to Tim or to myself. Tim can definitely get your information to me. We're happy to help you with those questions. That's what I do all day, every day. So if you have questions on anything, even if you just want to bounce some things off of somebody, I'm happy to answer any questions.
No, that was great. I appreciate it, Brad. And with that, we John, we'll go ahead and turn it over to you.
Yeah, and I think Brad nailed it on that. I was an investment advisor for 18 years, and as my business continued to grow and evolve, I realized that I could not be everything to everybody. And while I still do have an investment license, I'm no longer registered. But I think some of the things he touched on, the goal in retirement is to not run out of money. Okay, so these segments that we've been doing about long-term care, about estate planning, about liability planning, all those things, they all fit together. You have to have them working in harmony. And what's true today in your decision-making process about where to invest your money might not be true in 5 years, or it might be different depending on how your circumstances change. So what I always felt, and the way that I treat my own business and my own financial well-being is to create and nurture as many sources of revenue as you can. Some of them in the qualified space makes sense because of the tax savings or the tax deferral, the efficiency of that. And then certainly the best income is the income that you don't have to pay tax on when you're taking it in. So it is, I think, unique to an individual circumstances or to a family circumstances. And as Brad said, taking that holistic approach, not a one size fits all, but what's appropriate for your operation, what's appropriate for you individually will drive that decision-making process. So, all right. So tonight I'm here to talk about long-term care as it applies to farmer or rancher. So again, my name's John Wilbur. I'm managing member of Wilbur Price Insurance Group. We are a regional insurance agency serving most of Ohio. I am a Land is Your Legacy certified advisor, as well as CLTC, which is a certified long-term care advisor. And the reason that I'm certified in that is because over the years, as we've worked with farmers and with business clients and individuals, we get constant questions about long-term care. And at one point, we went out, and myself and one of my associates, Kimberly Boyce and Tuttle, went out and obtained the designation for CLTC simply because we wanted to make sure that we had all the information and that we were providing it to the people that were asking for it, and that we knew all of it. Okay. And this is an evolving market. That was several years back, but I just want to put out there, as Brad said, any questions that come out of this, feel free to shoot me an email, call me. You can call Kim, reach out to Tim, but we'll do what we can to help you guys. So let's go ahead and dig in. Let's see here. All right, some important things to keep in mind. Here's the legal language, if you'd like to give that a read. Move on. Okay, so the agenda tonight, why planning for long-term care expenses is important. The cost challenges associated with actually needing long-term care, and then how to create a plan. So like life insurance, nobody wants to think about long-term care. That means to most people that you're in a nursing home. I can't speak for everybody, but for myself, I hope that it doesn't ever come to that. I'd maybe like to go in my sleep, but the reality is that's not how it works out for a lot of people. And look at that, long-term care cost reality. So here's a reality. People are living longer and longer. Nobody can argue that. Probably anybody that's listening has a relationship in some way with somebody that has gone through this, a grandparent or a parent. Doesn't always mean that you're in a nursing home. As we get older, it's realistic to believe that we get frail if we live long enough. And it might not be that we need full care. It might be that we need help in our own home. It might be getting having somebody help get your groceries, or cleaning the house, or coming in a couple hours a day to, take care of you and make sure you have your medicine and that sort of thing. But 70% of people over 65 will need some type of long-term care. So 2 out of 3 people, right? And we don't like to think about that, but it is a reality. And at some point in time, it may become your reality. So when you look at how many people have actually reached out to somebody and achieved getting the help that they needed versus how many people will need long-term care, there's a massive gap there. And I think it's for that reason. It's expensive. It's, people don't want to talk about it because they haven't reached that stage in their life that they feel like it's going to be important. So as I mentioned before, it may not mean that you're in a nursing home. 95+% of the people that I've met with over the years on this topic have zero interest in being in a nursing home. And I kind of assumed that everybody didn't want that until I met a client that said, my mother was alone for years at home in long-term care, and we actually moved her to assisted living, and she loved it because she had company. Nobody had ever said that to me before. So again, this is one of those things that, you kind of need to plan for it. So whichever way it goes, you're prepared for it, and you're in the driver's seat. And I'll get into that detail about being in the driver's seat when you reach this a little bit further down the road in this presentation. So different types of care, and excuse me for that. Informal care. Okay, so usually it's not the first person. If you have a husband and wife together, one person ends up needing help, assuming that you like each other, you're probably going to take care of the other one, right? So the first person has the benefit of not only the spouse being there to help take care of them, but also all the money that has been saved across that couple's lifetime. So informal care being, care that's provided by family members or friends, or maybe a good neighbor that you might have. And then you have home health care, which is really professional care that's occurring within your home. So home health care generally is going to be an LPN, an RN, a doctor, maybe a skilled caregiver that comes in to help with nursing care, therapy, your personal hygiene, that sort of thing. And then outside of the home care, there's really a few different levels, okay? And one of them really doesn't apply as care, but there's independent living where you move into a facility where maybe you're in an apartment or a condo and you have help within the community, but you don't need much help, right? Just maybe somebody to help keep an eye on you, or some folks for you to be around. And then you have assisted living, where you need some level of care, but you're still able to do a lot of the things that you need to do in the course of the day, without supervision. And then a skilled nursing facility is what most of us would think about when we think about long-term care, and that's a nursing home, and that usually has to do with age-related. We just live so long that we need help, or chronic health conditions, things that aren't going away, that we need continuous monitoring of, and we need continuous assistance with, in order for us to be able to continue to live the best quality of life that we're able to, at that stage. Okay, so I don't think that this is probably a big surprise to anybody, but if you haven't looked at what long-term care costs, it's kind of frightening, really. These numbers are actually from March of 2020, so they're probably fairly accurate. So, and again, it might even be a little bit conservative, because I've had clients, farm clients, where mom and dad, I think mom started long-term care in the home at age 88. Dad lived to be 95. And great people. They lived a great life. He was at 93 years old. He was picking the kids up off the bus and driving the combine, and he was just kicking along. But at one point, the mother needed help in the house. And she ended up getting a local neighbor that came in and helped, and they actually charged $10 an hour, and between a few different ladies, they provided around the clock care. And when you do the math on $10 an hour, 24 hours a day, and then you look at that home health aid services number of $47,215, that's about 50% of what the real cost is. And that's obviously not a high wage for somebody to come in and do that work. So the point is that the costs are going up, and utilization of long-term care policies is going up, and that's primarily because people are living longer and longer as medicine continues to improve, and stem cell research, gene therapy, all the things that they're working on. Studies have shown that children being born today are going to live well past 100 years old on average. And as that continues to happen, there's going to be a larger need. And I'm not sure where everybody lives. I'm coming to you from the Century Hill Farm in Warren County, Ohio. But even in the counties surrounding me here, there's long-term care facilities of different types and varieties going up all over the place. And there has been for years. And the reason is obviously because utilization, the need for it has gone up tremendously. The same thing has happened with home health care companies, where more and more people are coming to the market to help fill that need. So when you look at a nursing home, the average here is $87,525. You can easily go a little below that, and you can go north of 100,000 pretty easy too, right here in Ohio. So that little note at the bottom of the screen is just saying simply that the average new home price in September of 2018 was $377,200. That was in 18, and markets were running pretty strong in 18, but today houses are selling within a couple days of the time they go on the market. They're probably even higher. So if you're going to buy a $300,000 house, the benefit that you have there versus having a $300,000 long-term care event, and you'll see the average stay here is 3.3 years. I've seen them go as long as 14. Fortunately, that gentleman was very wealthy and he was able to afford it, but it cost millions of dollars. The benefit that you have in buying a house is you get to spread the cost out amongst many years. You can take a mortgage for that. When you're dealing with a long-term care issue, you don't have that luxury. You get to pay for it now if you need the care. So there's some obvious things that come along with having to generate that much money. It has to come from somewhere, right? I hear advisors sometimes tell people that have, I won't go too deep into that so I don't get myself in any trouble, but when somebody tells you you can afford to self-insure, you really need to ask yourself, can you? I mean, can you afford it? And even if you can, where does that leave your spouse if you spend half the money that you guys have saved on long-term care, and she or he still has the rest of their life to live and may need that same help, again, without you there to help lower the cost and provide the level of care that they're needing. So candidates, okay, anybody with assets to protect or to pass on to their heirs. So even if you have a lot of money saved up, even the wealthiest people have learned to use life insurance and long-term care policies to leverage what they have so that they get a better result when they hit the end of the road, so that the people they leave behind are taken care of. They're not without a lack of assets. But if you're on a farm and a big portion of our balance sheet is land or it's equipment, or it's illiquid assets, things that can't be moved quickly, or if it's property and equipment, things that you don't want to have to sell because you need them in order for the farm to stay financially viable. That's a place where you really want to find out where, what are your options? What can you do, to help solve that problem? And then they say it's not just for the elderly. 92% of long-term care coverage purchases are under the age of 65. So why would you look at it earlier? Well, like life insurance, you have to be able to qualify, right? And the older you get, hopefully it doesn't change, but as you get older, the opportunity to develop some type of a medical condition that would prevent you from buying it or might cause you to be rated higher than a healthy person at your age, that risk increases. So it is a good idea to look at it. It is cheaper to buy it when you're younger. And as you can see, more than half of the policies that are written were written for people that were between the ages of 55 and 64. And then what I brought up before, affluent couples and individuals. Even if you have a large amount of assets, okay, if you can take $100 and turn it into $300 for this type of a problem, for a long-term care problem, and you can do that without giving up your $100, meaning that you can get your $100 back if you change your mind and decide you don't want it later. Well, if you really look at the details, that's something that's attractive to people at just about any level of wealth or level of assets, maybe I should say. So leveraging what you have to get a better result so that you have more money to pay for the cost, and knowing that if you don't ever use it, that it will still go to somebody that you want it to go to. That is why a lot of people really dig into this and find out the details so that they can make an educated decision. All right, perceptions of long-term care coverage. So we kind of touched on that. I could go all night on conversations I've had about this over the years, but we talked about the association with the nursing home, but we also know that most long-term care events begin at home. Right now, my mother-in-law is dealing with a situation where my stepfather-in-law probably should be getting professional care, but she's still taking care of him at home. And that's something to touch on, because when we have, again, if we care about our spouse or our family, one of the goals has to be that the person that is not receiving care should not become a prisoner in their own home. They should be able to continue to enjoy some semblance of the quality of life that makes them happy. And most spouses would want that for their other. Oftentimes what happens is that the other person is saddled with the responsibility, and they can't go out and see their friends, and they can't be away for too long because they're worried, or because there's so much that needs to be, taken care of, or they're concerned about what might happen while they're gone. And folks in that position, anybody that's had somebody in that position, or when you have somebody in the hospital and you're having to go visit them all the time, you know that while you may never complain about it because you feel so bad for the person that actually has the problem, that it takes a lot out of a person. I mean, it's depressing, it's exhausting. And that's a big part of the goal that you want to solve, is to make sure that you're able to coordinate the care and maybe provide some of the care, but that you don't become a prisoner in your own home, and that you're able to still enjoy some quality of life. And that means something different to everybody, but that's what you want to try to maintain, so that you can live your best life all the way through till the end. So on this slide, long-term care is complicated, or it can be. It's really not that complicated, but there's a general lack of knowledge. It is expensive. Everybody probably knows that, especially when, as we mentioned, it's purchased at older ages. Since most people don't shop for it until they're older, the cost can be prohibitive, and that's probably why a lot of folks don't have it. It reaches a point where the premium's X, and they go, "My gosh, I can't afford to pay that." There's also some distrust with the industry, and I think that's born out of traditional long-term care contracts. For years, and we'll touch on this here in a minute, but they sold what are traditional long-term care contracts are considered to be reimbursement contracts. And in the early days, they weren't very expensive. People weren't living as long. Not as many people were utilizing long-term care. Medicine had not come along as far as it has. What ended up happening is, and the other thing was, you might pay premiums into this thing for 25, 30, 40 years, and then if you drop dead before you could use it, you just lost all your money. Nobody likes that, but a ton of them were sold. Well, the issue, and anybody that's on here that has a traditional long-term care contract of any substantial age has probably seen this, but as more and more people fell into that long-term care qualification space, the companies that offered these plans found that they were not properly funded. They had not been charging the right premium for decades, or maybe they didn't allocate the funds correctly, or I don't know. There's probably 100 reasons why it worked out. But what happened is a lot of these companies, who several of them are no longer even in this space anymore. They quit selling long-term care. Utilization went up. Their payouts went up so high that they had to start coming back, probably mandated by the Department of Insurance, and raise rates. So some of the clients that I have that we did not write the plans for, they were 15 years before I ever even was in this business, have seen their rates double twice. And then a lot of offers come in to reduce your benefits and things like that. So, nobody loves insurance to begin with, but when you have things like that happening, when you've made a deal 25 years ago and then they keep changing the arrangement on you without you having any choice in the matter, it's a good reason to have distrust for the industry. Of course, some of the things that prevent you from buying it, you're trying to save for retirement, like Brad said. It's hard to balance, where to put your money, because we don't have a crystal ball on what's going to happen. And unfortunately, you just kind of have to strike a balance there in the middle, and again, build a plan that's appropriate for who you are and where you are in life. So, misperceptions of payment options. Okay, adults 50 plus, 53% of them are confident that they'll be able to pay for healthcare costs beyond what Medicare covers. So Medicare only covers up to 100 days of skilled care, and that has to follow a 3-night admittance to a hospital. Okay, for the same reason. Okay, on top of that, it has to be for an issue that is not going to last forever. It has to be known that the care that you're receiving is going to help solve the problem. Okay. We've heard a lot of things in terms of, I'm going to get it from the VA, Social Security is going to pay for it. You look at these costs over here, $36,000, is the maximum FRA benefit, but a semi-private nursing home room is $88,348 on average. So there's a pretty large gap there. If you don't have the tools in place to help fund that. Go on to the next slide. So we talked about this. 2 out of 3 people are taken care of by spouses and other relatives, right? 3 out of 4 are women. Women tend to live longer than men. We could probably go into the many reasons that that's true. But they oftentimes are the ones that come back to take care of family. And that's a very noble thing, but it's hard on them. And oftentimes they're giving up a job to come back and a source of income to their family to come take care of you. So one of the things that we like to try to prepare for and plan for is to make sure that if they do that, because you were so good to them, that you are in a position to pay them so that their family doesn't suffer financially because they've come to help you and given up their employment in the process. Okay, so the realities. I think we've covered a lot of this already, but there is a fairly good likelihood that most of the folks on this call at some point in time, if you live long enough, are going to need some kind of help. Okay. We know that the cost can be very high, and we know that women are particularly likely to be impacted by long-term care, especially as a caregiver. So let's go over the cost challenges. Again, Medicare, they're going to provide you a little help, but they're not going to be the solution for probably 99% of people. Okay. For Medicare to cover anything, an individual must have those 3 consecutive day stays in the hospital preceding the long-term care need. And then Medicare coverage is limited to 100 days of skilled care following the 3-night admittance to the hospital. The first 20 of those 100 days are totally covered, okay? But after the 20th day, the patient then begins to pay a copay for the remaining 80 days of care. Medicare is intended for acute care, not chronic care. So the moment that a condition is diagnosed as chronic, then the Medicare coverage stops, even if you haven't used your full 100 days. So what qualifies when, and this is true for every long-term care policy that I've ever seen, okay? So there's 2 triggers, or a combination of triggers. If you have a severe cognitive issue, okay, so lack of memory, Alzheimer's, could be dementia. If you have a severe cognitive impairment that's expected to continue on, if it's chronic, that by itself is a trigger. That will start the process of qualifying the payout of your long-term care policy. And then the other is a combination of 2 ADLs, activities of daily living, and they're listed there: bathing, dressing, getting to the bathroom, eating, transferring from the bed to a chair, the wheelchair. Any 2 of those things are also a trigger. And if the plan of care for either of these is expected to last longer than what they call your waiting period, in most cases 90 days, and that will begin the process of your claim being opened up and the money in your policy beginning to pay out to help you cover the costs for the help that you need. Okay, so if we're trying to create a plan, how are we going to do that? So, well, what if you don't plan for the long-term care costs? So every dollar that you have is on the table for you to spend to pay for long-term care, because without a plan, then what you have is your assets to help fund the cost of your care. Do you have family members that are willing to take care of you, and at the age that you reach the need for long-term care, will they be in a position to do it? Especially if they're as old as you and both of you get frail at the same time, can they do it? You have to ask yourself, what are you going to sell first? If your largest assets are farm equipment and land, and the goal is to keep the farm going, is that really a good plan? And then if your family has to provide care, and if they have to liquidate assets or burn your 401k account or whatever to cover the cost of your care, what does that mean to them long term? What kind of position are you leaving them or your operation in after you're gone? Is there going to be enough money there to keep the wheels on the machine? So definitely important things to keep in mind as you research this topic. And here's a few other important things to keep in mind. So here's how you get started. I would like to point out long-term care, again, is one component of many. The work Brad does in helping people save to make sure you have the right plan, the right strategies, the right advice as you're saving to get into retirement should be coupled with protecting yourself with life insurance if it applies to you, long-term care coverage for the unknown that may or may not come later in life, distribution plan as you get into retirement. How do we distribute all the money we've saved in a way that we're not ever going to run out of money? And then if you are an active farm or ranch and you want to keep the farm alive for generations to come, what's the plan? Brad touched on Land is Your Legacy. There's a very talented team of folks that have done plans for more people that are our clients than I can even tell you about. I've seen some amazing things happen that I can honestly say without that help, the farm probably wouldn't have survived. The things they find in deeds, they model your assets, they research all your legal documents. People are amazing, and they will do that work for you as a farm bureau member. And as much as I hate to say this, they don't charge you for doing it. It's pretty amazing, and that's one thing. I'm an independent agent, and I write with a lot of different insurance companies, but Nationwide, I don't know anybody that's done anything like what Nationwide has done in this space. So they're a great partner to help you through some of these challenges. And they've been a great partner of mine as well. So how do we get started? You get a personalized long-term care cost estimate. Okay, that's not a very deep process to go through. You consider what your coverage options are. You want a traditional long-term care policy. I haven't sold one in many years. Do you want life insurance with long-term care on it? Okay, with long-term care coverage. So you can actually buy a life insurance policy. Let's say it's a $500,000 permanent policy, and you can get long-term care coverage at $500,000 on that policy. That ensures that no matter what happens, whether you use none of the benefit or you use half of it or 3/4 of it or 25%, that $500,000 is going to go to somebody that you care about. Okay, it's either going to be used during your lifetime to cover the expense of long-term care, or it's going to go to your beneficiaries tax-free, which is, again, the best kind of income. Then they have a variation of that where you can buy a policy that has a lot more long-term care than it has life insurance on it. So you might put in over a period of time or in a lump sum, you push some money into the contract, and it'll amplify the value of those dollars by 2, 3, or 4 times if you're using it for the purpose of long-term care, which is really a cool thing, because a lot of those contracts, again, if you don't need the life insurance as much as you're concerned about the long-term care expense, a lot of those contracts have a return of premium on them. So if you get down the road a ways and you run into an emergency, or maybe, I don't know, you just decide that you don't believe in long-term care insurance anymore, you can get your money back through a lot of those products. So that's pretty awesome. But more than that, you know, if you had X amount of dollars in the bank that you were going to use to pay for long-term care expenses, especially for folks that have CDs, things that aren't bearing much fruit in the interest world right now, you can take that money out of your left pocket and put it in your right pocket and get a lot better result for it without losing your money. It's still your money. So that's something that a lot of our clients have done to create leverage to solve that problem without giving up the asset. And then we do have some other options out there for somebody that's uninsurable. Maybe there's already health issues. There are investment vehicles out there that are of the fixed variety. They typically come in an annuity wrapper, but there's some very interesting solutions that you can get into without having to qualify medically. So that's another potential solution for folks in that situation. And then you consider your potential sources of funding. So it might be RMDs, required minimum distributions from IRAs, systematic withdrawals from an annuity. I just touched on that just a little bit. And then, of course, money that's not needed for retirement, or maybe is not factored into your retirement income, could also be leveraged or applied to get a better result in the long-term care space. So you can start with a healthcare long-term care cost assessment. You determine the individual long-term care costs for yourself. We know that a couple that are both age 65 today, living to average life expectancy, could need as much as $296,000 to cover premiums for health insurance, not long-term care, health insurance, and out-of-pocket expenses related to their health care during their retirement. And a couple who lives to age 95 could need as much as $400,000. This is just an average couple. So it's an important number, but it's a realistic number based upon personal health history, which would be, much more valuable. So Nationwide came up with this cost assessment tool. It was developed by a team of professionals, including leading doctors, actuaries, using proprietary health risk analysis and up-to-date actuarial cost data. So they will analyze personal health and lifestyle information, the costs in your area, actuarial data, and your medical coverage. And the result is a meaningful, personalized cost estimate that can help you plan for future healthcare expenses, including Medicare, out-of-pocket, and of course, your long-term care costs, which is obviously the focus of this conversation. So with the tool that we're talking about here, they can assess your health status and how it may affect your future medical costs, especially if some things exist now. And then they can estimate your years in retirement and the healthcare costs during those years. They can also assess alternative scenarios. So what is as an example, what is the financial impact if you retire 1 year earlier or 1 year later than you currently plan to? What does that mean to you overall in terms of your financial profile? So kind of touched on that. How long you expect to live, the impact of not taking action, we talked about that. The estimates of potential costs of care, that'll all be factored into your personalized assessment. Here's what it looks like in its plain form. And then here's going a little bit deeper in it so that you kind of know what to expect as you go through this process, if you choose to. It starts with a 3-part questionnaire on your health history, your lifestyle, the history of medical conditions. It also lets you choose a geographic region for retirement, which will allow them to be more accurate in calculating the cost of long-term care in that specific area. Okay, completing this assessment is critical as your first step in planning. Okay, the report will tell you about your health profile, the risks, health risks, estimated life expectancy. Costs will be broken out into Medicare, out-of-pocket, and long-term care expense categories so that you can take an even more detailed look into what their costs will be. It'll help you determine what you may need to fund these costs and then potentially where are you going to go to get it? How can you accomplish it? So you'll see down here the client facts. This will be all of your information down here. It takes into account your current health, blood pressure, whether you have diabetes, all of these things. And they're basically using big data to kind of predict what you might run into as you go down the road. Okay, well, and there blew it up a little bit so you can see it a little bit better. That's going to show you what your healthcare expenses are going to look like in retirement. Okay, and as you can see, as we all know, for any of us that pay for health insurance, it doesn't ever seem to go down. It might go down for a little bit as we get onto Medicare and buy our supplement after we get off our traditional health plan, but it's modeled to continue to increase. It always has as you age, and that's kind of what this is pointing out here. And then the average annual cost of healthcare in retirement based on years. So as you go across the bottom of the annual expenses on average for folks. And then they're going to show you the detailed view of it. Okay, and this is dealing again with your Medicare, your Part B, your Part D, or your supplemental premiums, and then what they expect it's actually going to cost. And this is, again, just an example. But this will be set up specific to your situation as you go through this process. And then they're going to go deeper into the long-term care piece, and obviously a lot bigger numbers. That's a lot bigger risk for you and for everybody in your family if long-term care does come into the equation. So medical insurance, very expensive. Long-term care insurance can make it seem, I don't want to say insignificant, but a lot bigger expense associated with this. So, and again, you can see here based on the information that you provide, they're going to be able to project about when they think that you would actually need to start receiving long-term care. Now you look at the costs over years, right? I mean, 2046, it seems like a really long time from now, but I mean, it'd be here a lot quicker. As we've all found out, as every year passes, it seems to go a little bit faster. But you know, if you're in your 50s now, 2046 will probably be a reality. And look at the cost of nursing home care. You know, in that year, $211,000 annually. So how much money do you need to have? I mean, even if you have $1 million. $2 million sitting there in cash and it's available to spend for this. My gosh, if you're in it 4 or 5 years, you're going to burn a lot of money. So it's worth just, I guess what I would say is just get the information. If you're concerned about it, get the information, fill out the form, and maybe start getting some direction on maybe, you know, what makes most sense to you and your family, your spouse, as you go forward, and considering all of the, you know, all the information that is specific to your family. It might help you in a decision-making process on what to do going forward. So as you fill this out, this is just kind of a walkthrough of what you'll go through. You can decide, you know, whether you want to see Medicare or just long-term care, both. They'll ask you your personal information here. You can check in here whether or not you'd like to go over this with one of Nationwide's reps. So that could be me. There's many other advisors out there that are very good at what they do. But I certainly would be happy to talk through this with you if you would like me to do that. And then the information about your spouse. Here's the questions they're going to ask, okay? It's not anything too scary. It's information you probably already know. And your spouse will know certainly as well. They're going to ask you an income number or range on your income number. Medicare coverage. What do we have? So you can complete this form and you can send it back to this email. You can send it to me if you'd like to do that, and I can submit it for you. Or again, you can just send it right into Nationwide Advantage Direct. And if you want some one-to-one help, ask for an advisor or give me a call. My information will be made available at the end of this presentation. And myself or one of my colleagues, Wilbur Price Insurance Group, can help you with that. We've done a lot of this over the years and seen it do a lot of good, and have people turning on these contracts now that bought them many years ago. So we've covered a lot here, okay? And I've only got a couple more slides, and I know we need to be done because we're running past time here. But you're going to take one thing away from this. The main thing I would take away from this is that when you buy a plan, you want to make sure that it is an indemnity plan, that fourth point on this slide, indemnity versus reimbursement. What that means is the old traditional plans were reimbursement plans. That means that you had a certain amount of benefit per day for a certain amount of years with a certain total benefit pool. Okay, and you had to receive services from an LPN, an RN, or a doctor, and you would submit those, and they would reimburse them after you've paid them up to a certain amount. So that doesn't always work out too well if you need part-time care. You're not getting a whole lot done. When you have indemnity care and you meet two of those activities of daily living, or you have a cognitive issue, the company pays you directly in most cases without any accountability on how you spend the money. So if you want to spend the money, this is what I said about you being in the driver's seat early in this conversation. If you like to fish and you want your wheelchair strapped into a fishing boat so that your nurse and you can sit on the lake and fish all day, having two activities of daily living or needing some help doesn't mean you're dead. You can still have a good quality of life. You just might need a little bit of help. Well, indemnity care puts you in the driver's seat, okay? And that allows you to spend the money how you want to spend it, and the excess funds that you have are yours to spend how you want to spend them, okay? You want to check out what these policies cover. Not all long-term care policies cover the same services. Okay, so you want to make sure that you definitely understand what those are. You want to know if they cover temporary claims and what happens to the premium when you're on claim. Okay, there's a lot of life products with what they call chronic illness riders that will only cover that condition if it lasts the rest of your life. So I apologize for running a little bit long on this, and I just realized it at 8:33, so I apologize. But hopefully you got some useful information out of this. Here's another little comparison between indemnity and reimbursement plans. And with that, I'm going to go ahead and wrap this up.
John, thank you very much. I thought your deep dive into long-term care coverage is definitely something that many folks don't really, it's one of those topics that folks don't like to kind of research and think about and kind of work through. But it's definitely one of those challenges when you get into that phase of your life that you had better have a plan for. Because there are going to be expenses that are going to be tied into it. So really appreciate Brad and Ivory and John for presenting tonight. So some of the takeaways that I've heard in these courses is developing a plan is vital to your success. Everyone in agriculture is kind of coming at it from, it feels like a very unique situation with a set of variables that are uniquely your own. And while that's largely true, we do tend to be different than John Q. Public. Many of the issues and needs that we have within the industry and the revenue streams, there are tools and there are resources and there's support out there that can help you build that plan that's going to get you the future that you want. So working with someone like John or Brad are great resources. We at Farm Bureau want to make those available to you. If there's resources out there for you, reach out to your county Farm Bureau. We'd be happy to put you in contact with some of the folks that can help solve these challenges for you.